You are listening to Keystone's Stock Talk Podcast, episode 167. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We're back, starting with a star of the week from our Canadian small cap growth stock research, Dynacor Gold Mines Inc., symbol DNG on the TSX, a company which should be no stranger to our clients. The company purchases ore from small-scale miners or artisanal miners in various regions of Peru, processes it at its mill, and sells the extracted gold and silver internationally at market prices. The company just reported record Q1 2022 quarterly revenues and earnings and appears positioned for further growth, and we'll take a look at it. In our Stock versus stock segment, Aaron answers a listener question on which tech online retail enabler, Amazon or Shopify, offers better value in the current market. The listener wonders if Shopify, which is down an astonishing 75% year to date, is finally offering value. So let's get into the show this week. I'm going to welcome Aaron Brennan. I think he has, a tummy ache or something like that?
Oh, I heard he stubbed his toe or something like that. Yeah, he says he's not up to doing the podcast today. So
it's true.
Honestly,
we're gonna have to rip him next.
The quality of the recording can only benefit from that. So
I predict.
He says he's sick, but I looked at his Instagram and I can see some pictures of him out partying last night.
Yeah, it's true.
Yeah,
we've seen that. On a related note, did we not see that for somebody who interviewed for a job last week?
Maybe we did.
Maybe we did. Maybe we didn't. There was hundreds of people.
But we definitely saw it for Brennan.
We definitely saw it. Yeah.
Yeah, that's good.
I'm just going to say he's not alone. Now, it is interesting markets. Any comments on the market?
Yeah,
generally speaking, before we get into Dynacor here?
There's no lack of comments on the market. One of the things that I was thinking before the podcast.
We could go on and on.
Yeah, there's so many things going on right now. Like there's just so much to talk about. It's probably, putting the drop that we saw during the COVID period aside, this is probably the most volatility I've seen since 2011, and it may be getting to the point where it's even exceeding that. I'd have to check the record, but COVID, obviously there is a very understandable explanation for that as the economy was shutting down, and there is also an understandable explanation for the fear that we're seeing right now. But I was looking at the NASDAQ today, down 26% year to date. And most of that is the tech sector. It's other sectors as well, but most of that is the tech sector. Some of these companies have just been absolutely smashed. And we've talked in the past that we have a list of tech companies in the U.S. that we're going through, researching, and we think that there could be some potentially great opportunities, long-term opportunities coming out of this volatility. But what we've had to do over the last couple of weeks here is really go back to the first step, because the companies, the prices kept going down. So there's a lot of companies where, we might have not considered them in the first round of research that now we're having to throw them back in. But pretty crazy. The S&P 500 down about 16% year to date. So not as tech heavy an index. And that's the reason why. But interesting. This is going to be, likely it's turning out to be the first year in a while that the TSX up here in Canada is going to have a substantially better performance than in the US, because the TSX is only down 5% year to date compared to the NASDAQ 26. And normally over the past 10 years, in pretty much every year with the exception of one, the U.S. markets have completely destroyed the Canadian markets with respect to returns. And of course, the reason why Canadian markets are shaping up so much better this year is because of energy. So the capped energy index is up 48% year to date due to high oil and gas prices, which is crazy. I mean, energy has been a horrible place to invest for most of the past 6 or 7 years. But over the past year to 18 months, it's been propping up the Canadian market. So
yeah, and this is why we've always talked about it as a trade versus an investment. I mean, if you look back at investing in it 5 years, 10 years, 20 years, it's not a sector that you'd have a long-term sustainable investment in. If you would have luckily timed it correctly, over the past 12 to 18 months, you would have done well. Now, going forward, is it, where 30-40% of your portfolio should be? No. I mean, it shouldn't be in any sector
although
like that.
Energy does make up about 25-30% of the Canadian market, which is pretty crazy. We would not. And this is a large reason why the Canadian market has underperformed a lot of other markets from developing countries over the past decade, are certainly over a large part of it. But, I would just say, yes, oil and gas, more of a trading asset, or perhaps something to just hold a long-term, smaller allocation in. So one of the companies that we've recommended this year in our dividend stock research is a oil and gas royalty streaming company, diversified between Canada and the US, pays a nice dividend, really nice dividend actually, and producing outstanding performance and giving people direct exposure.
And less volatile. And royalty is just less volatile way to have exposure.
Exactly. Like you're getting...
It will have volatility.
You're getting in a strong oil market, you're getting, 90% cash flow margins on it, which, it is... And people have asked me, is the dividend safe? No, the dividend's not safe. It's pure commodity price exposure. But if you want to get some exposure in your portfolio that you just basically hold more or less long term, but it's a relatively small part of your portfolio, maybe it's 5%, then that's one way to do it, right? What I find with the oil and gas producers is that, well, one, as I said, they've been, for most of the last 6-7 years, a horrible place to invest. But also, it's just such a complicated business. I mean, you really have to understand the properties, where they are, the decline rates. There's a lot of technicals. I mean, I've talked to management teams before about what's going on with their company. You really almost need to be a specialist in the area to really fully understand what's happening under the hood. And then, of course, a lot of them, particularly in Canada, have high debt. They pay high dividends, but then they're also a very capital-intensive business because they have to put a lot of money back into their properties just even to maintain production. So to do that, they're taking on debt, they're issuing shares. And I personally don't like that model. I don't like the model of paying a high dividend, but then having to take on a lot of debt just to maintain production. To me, that's not an ideal situation. So we thought royalty streamer was one way to get some high risk exposure to the area, high risk relative to, like, say, other companies that would be more defensive, not necessarily high risk compared to other energy producers. But I mean, that's another way of looking at it, but a smaller portion of your portfolio with the understanding that it's going to be volatile, but you at least get to participate when the energy markets are strong. The bottom line is that I think that I know that there are a lot of uncertainties, and there are good reasons why investors are concerned right now, from the inflation to the rising interest rates, supply chain, labor market. And if you look at, we never try and predict if a economy is going to go into recession, because it's not just about predicting the likelihood of a recession. You have to time it properly. You have to predict the severity of it. It's just not a way to invest. So we are always focused on building a portfolio with different types of businesses so that the portfolio overall is well positioned to perform in a variety of different economic scenarios. But we certainly, looking forward here, there are a lot of uncertainties and risks, but I also see a lot of opportunities, and certainly in the tech space. Companies have been, the companies that we have research out on in certain areas like tech, industrial REITs, other areas as well. Like the performance in Q1 has been extremely strong. I was looking, a few companies on our monitor list in US tech that we're doing a lot of research on, like one being NVIDIA. That company's down 50% from its highs in November. They're expected to grow their earnings per share 27% this year, another 19% next year. They're trading at 30 times earnings. Now, 30 times isn't cheap, but compared to where it was a year ago, 70, 80, 90 times earnings. And this is a great company. Creates the best GPUs in the world, which are used in data centers for AI, for gaming, cryptocurrency mining as well. There's Advanced Micro Devices, AMD, down 40% from its highs, expected to grow earnings 58% this year, 14% next year, trading at 22 times earnings, way below where we've seen the valuation over the past couple years. And the chip space is really interesting to me, computer chips, semiconductors, because these companies generally haven't fared well either, but we're in an extreme chip shortage right now, and there are many companies that are reshoring semiconductor and computer chip manufacturing back to North America. They're investing billions of dollars. Micron Technology announced $150 billion investment into its manufacturing capacity because the demand for chips is so high. That company's down 26% year to date. Earnings expected to grow 58% this year, 31% next year. It trades at 8 times earnings. A little bit of a different story than the other two, just because it does have more cyclicality in its business, a little more financial volatility over time. But I was listening to an interview from the CEO of Qualcomm, and he was talking about what the reasons for the chip shortage are. And a lot of people will blame the pandemic. And he said, well, that definitely made it worse. But he's like, what the real issue is there's just been an explosion in the demand for chips that had nothing to do with the pandemic. So the pandemic definitely accelerated that shortfall. But I mean, if you just look at the auto industry, for example, the electronics that go in a car, there are thousands of chips now that go in some vehicles. Deloitte put out a report, 18% of a car's cost was electronics in 2000. It's now over 40% and expected to continue to grow to 2030. So a lot of companies expanding capacity, and it appears that the demand is going to be there, even with the expanded capacity, that they're not going to be able to fully meet the demand. So huge uncertainties out there, but also huge opportunities.
Yeah, I think that's what we're seeing. And just commenting on that, the encouraging element would really be the demand side, and it's not just a supply side issue. And that would make it probably more sustainable.
Oh, absolutely.
In that sense.
Yeah. And I'm a big believer, and I've said this many times, that I believe that the way out of the problems we have is really innovation, whether you're talking about climate change, whether you're talking about supply chain issues, inflation. It really comes down to innovation. So I don't think that technological innovation is going anywhere. Digitalization trends are going to remain over time. They may slow in certain periods, depending on what's happening in the macro picture, but these are long-term trends, and I think that there's an opportunity for investors to benefit from them and invest in that, which is exciting.
Yeah, and I think generally with the markets, it's correcting significantly and severely in some cases. What I would put out to our clients and to listeners out there, you just we're looking at every company in our portfolios, and many of them we're seeing performance. The underlying performance of the business has been good. The markets generally have been bad. What really worries us is if the underlying performance of the businesses is poor, regardless of what the market is doing. In this case, like I'm going to talk about a company right now. It's seen its share price pull back, not nearly what the market has done over the past 6 to 12 months, but the underlying performance has been tremendous. So that doesn't worry us. And in those cases, you're often either buying more or starting new positions for new clients in those companies. So, looking at each company that we're holding, looking at each company that you're holding, and if the underlying performance is weak, then you're worried. If it's not weak and the overall markets are weak, you shouldn't lose sleep at night over that in your portfolio. And again, we're going to talk about one of our stars of the week. We saw its share price pull back, particularly last week. It's jumped following the results that came out this week, or just today. But let's talk about the company. From our Stars and Dogs segment, it's time for this week's Star. Dynacor Gold Mines, DNG on the TSX. Our clients should be very familiar with it. Why is it a star? Well, record quarterly results put out Monday of this week. Shares jumped from a low of 264 to around 310 on Monday following those results. Dynacor has a very simple business model. What does the company do? They purchase ore from small-scale miners or artisanal miners in various regions of Peru. They process it at their wholly owned Veta Dorada mill and sell the extracted gold and silver internationally. It's primarily gold, though, at market prices. As a result, the profitability of the business depends on two factors: a margin between the price of ore purchased and the market price of gold. The higher the margin, the better. And we saw that increase in this last quarter. Throughput is the second thing, the amount of ore processed essentially. The higher the throughput, the better. One other factor, that we'd put in there is a higher pricing, gold pricing environment during a quarter encourages, or overall during a period, encourages more small-scale mining, which grows Dynacor's ore supply and creates profitable growth for the business. So let's look at what happened in Q1 2022. There was higher gold production, gold market price and trend, and favorable exchange rate. The Peruvian sol against the US dollar boosted overall financial performance. Sales were up, revenues up 22.5%. Greater quantities and higher gold market price. Revenues came in at $50.1 million compared to $40.9 million in the same period last year. Earnings were basically in line with financial guidance if you consider the non-cash deferred tax recovery, but there was tremendous growth here. Net income came in at $5.1 million for Q1 2022. That's 16 cents per share Canadian compared to about 5 cents or 6 cents per share Canadian in the same period last year. Now, Dynacor has a great balance sheet for a company of its size. Cash on hand is $25.7 million US. That's 85 cents per share in cash Canadian. Again, the stock trades just over $3, so 85 cents of that is in cash. So let's conclude here. Dynacor is not without significant geopolitical risk operating in Peru, but it has operated profitably in the country for well over a decade. The company has solid current growth and multiple avenues for expansion, which we have detailed recently for clients. Keystone has been recommending Dynacor for several years, and we reiterated our spec buy on the stock in our Canadian focused buy portfolio last year. At the start of last year at $1.80. The stock has performed very well over that period in a down market, closing today above $3 and increasing its dividend 3 times to a current yield of 3.6%. We expect another dividend increase in 2022. Despite the jump, Dynacor shares currently trade with a trailing PE of 6.37. Removing the cash, that PE is 4.63. Its price to FFO trailing is 5.5 approximately. And the company does expect growth in 2022. Yes, again, it deserves a geopolitical risk as well as a discount to the average market PE, for example, because of its exposure to gold, which is a somewhat volatile commodity. But the discount right now appears to be very high. We will be updating clients on the quarter and its outlook this week. Dynacor's 75% gain, not including its dividend in a down market over the past year, make it our star of the week.
Great story. As you said, in Peru, so you have to factor that risk in, and it's one of many companies in your portfolio. But there you have a company that ticks so many of the boxes: growth, a cash-rich balance sheet, pays a nice dividend, increasing its dividend, has a strategy for growth going forward, and a reasonable valuation. So it ticks all those boxes. Higher on the risk spectrum, somewhat, at least compared to like many of our other recommendations, but not so compared to other small cap mining companies. I would say less risky than that group.
Yeah, and I'll finish by saying, it's a great example of the unique research that we can provide. This stock literally has no other analyst following it in Canada. It's no coverage in Canada at all. You might ask why. It's a very profitable business. Well, that's one of the reasons. It holds all the cash it needs to grow. doesn't need to raise any capital. So at present, Bay Street or the big banks, which make their money from raising capital, despite what you might hear, not from picking or investing in great businesses, they have little interest in covering it. It's not going to need any money, so they're not going to get any money through a financing. We're happy to take the increasing dividend, strong price gains, and value like this doesn't stay hidden forever, and it'll be recognized over time. We've seen it happen before. So Aaron's going to look quickly right now at Shopify and Amazon. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Do a versus on these two. A client had asked, with Shopify significantly down just year to date, I think it's almost 75% in that range. Do we see great value here suddenly? Aaron, I'll let you take those two.
Great. Thank you, Ryan. So as Ryan said, Shopify, Amazon, two companies that get compared a lot. I've heard Shopify referred to as the Amazon of Canada many times, although I don't think that that's totally accurate. But I'll get into this. I'd spoken before about tech companies having such negative performance since November and year to date. And Shopify is the tech giant of Canada, virtually our only real super or mega cap tech company here in Canada. I think at one point it was over half of our technology sector. So what we're going to do, we're going to compare these two companies. I'll start with just some information on Shopify. It's trading at a price right now of about $470, a market cap of $54 billion, making it still one of the biggest companies in Canada. But it was previously the largest by market cap, I believe. The company is down about 80% since November, as Ryan said, about 75% year to date. So it has been absolutely smashed. Compare this to Amazon. Amazon trades on the NASDAQ exchange in the US. The share price right now is $2,223. Much larger. It's a $1.13 trillion company, so over 20 times the market value of Shopify. And it's also had a tough several months, down 40% since November. So what do these companies do? And this is really where, Shopify is compared to Amazon a lot. There are some similarities because they are both in e-commerce, but very different companies really. So what Shopify does, just briefly, they provide a platform that allows merchants to set up online stores, websites, and e-commerce on a variety of different platforms. So essentially, you're a business, you want to engage in e-commerce. They have a plug and play system in place where you can integrate their e-commerce tools. You can set up a website really easily and host that through Shopify. Now, Amazon, a little bit different. So as we know, it's the largest e-commerce platform in the world. So you actually sell your products through Amazon.com. That is not the same case as Shopify, that you don't sell your products through Shopify.com like you would do Amazon.com. So Amazon, you actually sell the product on the platform as opposed to building your own website, generally speaking. And then in addition to that, Amazon is also the largest cloud computing company in the world through their AWS platform. So this is really important because cloud computing is a huge theme in tech right now. This has been a major growth driver for Amazon and a major win to be a first mover in this space. So right now they own about 33% of the global cloud market. This is a market which is generally growing at about 20% more or less per year. And we consider this an essential industry because, for example, during the pandemic, when communications, workflow, data was going online, this was largely going through the cloud. So the lockdown really accelerated that cloud trend, but the cloud trend has not slowed so far. So looking at the financial performance for Q1 of 2022, we'll start with Shopify. Total revenue in the first quarter grew 22% to $1.2 billion. Compare that to Amazon. Their net sales grew just 7% to $116.4 billion. So far less growth, but far higher revenue. So coming off of a smaller base for Shopify makes it a little bit easier for them to grow. Shopify is really just starting to get into what I would call real cash-based net income. So adjusted net income for the first quarter was $25 million or 20 cents per diluted share. Compare that to Amazon. They produced They produced adjusted net income of $3.8 billion or $7.56 per share. Now, this was actually down from $15.80 per share in the same quarter last year. So 7% growth in revenue for Amazon, but about a 50% cut to their earnings per share. Now, Amazon did continue to post really strong growth with its cloud computing platform, AWS, which grew 37% year over year in the first quarter, and really solidifying itself, fighting off competitors and maintaining its market share. Now, if you look at historic growth over the past 3 years, Shopify's revenue has averaged about 62% growth annually. Compare that to Amazon's revenue averaging about 26% growth. Amazon has also averaged about 26% growth in cash flow per share over the past 3 years. Now, Shopify, they're really just starting to get into cash flow and profitability. So they're coming off of a much smaller base, which means that the cash flow growth is just really not comparable. It's not a good comparison. And when you look at outlook, both companies are really expecting to see growth slow, at least in the near term. So what we really saw was e-commerce demand peak during the pandemic lockdowns. Both of these companies produced stellar performance, but both are expecting to see a slowdown in growth. For Shopify, they're expecting to see slower growth as they did in the first quarter. That's going to continue through the first half of this year. They do expect to see growth start to improve towards the end of the year, such as Q4. One of the comments that was made is that some of the contract terms on their subscription business will be a headwind to growth in the first half of the year for Shopify. And for Amazon, similar situation. The company is not releasing guidance, but earnings peaked in 2021 due to very strong pandemic demand. They had some of the best performance, historic performance for the company. Analysts are expecting to see a drop in earnings for 2022, then a return to growth in 2023, but still below the peak levels of 2021. And then once again, the cloud computing business, however, is expected to continue to remain strong going forward. So valuation, Amazon right now trading at 43 times expected 2023 earnings. This is definitely a premium to the market, well below Amazon's historic valuation level, which also reflects lower growth expectation. Shopify, 134 times expected 2023 earnings per share. So in spite of an 80% decline in the share price since November, this is still one of the most expensive stocks on the market, 134 times next year's earnings, not even this year's expected earnings. What's our conclusion? Well, Amazon is definitely the much more mature business. Shopify has produced better growth in revenue over the last 3 years. That's largely because they're in an earlier stage of their growth trend. They're coming off of a lower base. Both companies seeing growth rates decline in the near term due to e-commerce growth peaking during the pandemic. Shopify starting to produce profitability, but profit per share is really still quite low relative to the company's share price. And it's extremely expensive, even though it's corrected a massive amount over the past several months. Amazon trading at a better valuation, still a premium to the market, better than its historic, but the reason for that is the slowing growth. We would definitely say Amazon by far is the much more defensive business, more defensive in e-commerce because Amazon.com is just much more of a brand. People just go there. It's a lean, mean machine of a business. So that's, you might see some fluctuation in growth and revenue, but they have a strong foothold there. And then there's also their cloud computing business where they also have a very strong foothold. So two leadership positions in important trends. Shopify, on the other hand, it's an interesting business, but it's much more likely to be exposed to competitive pressures. It's less defensive. It's less diversified. Right now, we aren't a buyer of either of these companies in the near term, but if I had to pick between the two, I would definitely choose Amazon over Shopify for long-term investors. I just think that Shopify, there are just too many unknowns. I like to see that defensiveness in Amazon's business. And once again, I can't state too much how much I love cloud computing as a long-term trend.
Yeah, no, it's a really good summary. I think it just, one of the things that stands out, it's shocking that Shopify can correct 80%. I mean, that is a massive, that's not a correction, that's a crash. Sorry, I shouldn't say correct. And it still looks fundamentally expensive, at least in the near to midterm. It's particularly with slowing growth. It is good growth, but it's slowing. It just shows listeners how, frankly, insane valuations were by late last fall after the, what we can call it pandemic-induced run-up that we saw in technology. To see that stock go down 80% and it still be at 134 times 2023 expected EPS. So it's a cautionary tale. Everybody wanted a piece of Shopify, over the past couple of years, but it's destroyed a great deal of capital because people were willing to pay just anything for even what looks like to be a very good company. You can't just pay anything, and we talk about that all the time. So let's find growth. Let's find it at a reasonable price. That's what we're looking to do. Looking at about 350 plus U.S. tech companies right now over the next couple weeks to find some value for our clients in what has been a significant sell-off. So keep your questions coming in to our Your Stock, Our Take. You want us to compare two companies like Amazon and Shop. We'll do it every week. Rate us, review us if you like this content on iTunes, and we'll keep pumping it out there for you. As always, I'd like to wish you profitable investing, and thank you.
Thank you. Profitable investing.